The broadcast is now starting. All attendees are in listen-only mode.
Bismillahirrahmanirrahim. Bismillahirrahmanirrahim. Alhamdulillahi Rabbil Alameen. Wassalatu wassalamu ala ashrafil mursaleen. Sayyidina Muhammadin wa ala alihi wa sahbihi ajma'in. Dear brothers and sisters, Assalamu alaikum wa rahmatullahi wa barakatuhu. The Islamic Research and Training Institute is pleased today to have Dr. Muhammad Khaleequzzaman again to present his research paper. The title of the presentation is Enhancing Financial Inclusion Through Islamic Microfinance in Pakistan, Operating Systems and Product Development Perspective. Dr. Khaleequzzaman is visiting IRTI these days under the IRTI Visiting Scholar Program. Most of the work that he will present today is the outcome of his consultation with IDB technical staff and the research while his stay at IRTI. Dr. Khaleequzzaman is engaged as a consultant associate professor in School of Islamic Banking and Finance at the International Islamic University, Islamabad, Pakistan. Dr. Khaleequzzaman has earned his PhD Islamic Banking and Finance from International Islamic University, Islamabad, and his master's from University of Illinois, USA. Dr. Khaleequzzaman has more than 2 decades of working experience both in the banking industry and the academia. Currently, he is engaged in the development of financial and social sector, preferably related to financial inclusion with Islamic perspective. He has worked as a consultant on a number of projects sponsored by various national and international agencies. We are honored to have Dr. Khaleequzzaman, IRTI visiting scholar for 2 months. He is helping IRTI in developing models and panels for Islamic microfinance interventions in Pakistan. Now I would like to invite Dr. Khaleequzzaman to deliver his presentation. Dr. Khaleequzzaman, it's over to you.
Thank you very much, Dr. Dawood Ashraf. Bismillahirrahmanirrahim. I'm really grateful to IRTI and Islamic Development Bank affording me the opportunity of being the part of this team. And I have actually very much concerned and am grateful to all the scholars, particularly in Islamic Research and Training Institute and Agriculture Division in Islamic Development Bank. Enhancing financial inclusion through Islamic microfinance in Pakistan, operating systems and product development perspective is in fact an attempt to develop the outline for the operating systems and also the new products which could accelerate the financial inclusion process in Pakistan. So that is why the objectives are focused on reviewing the concerned literature related to the Islamic microfinance models and products in Pakistan as well as elsewhere, and especially in Indonesia, Sudan, and Malaysia. So the second objective that relates to that, based on the review of literature, an attempt has been made to present the operating models as well as the financial products suiting to the micro-enterprise environment in Pakistan. There are certain issues which are harming the development and progress of Islamic microfinance in Pakistan. And the first and the foremost is very thin outreach because of a number of factors, which include the absence of the affordable supply of funds, the sustainability of microfinance institutions, as well as the standardized procedures related to operation of the microfinance products in the country, where most of the concentration has been in Murabha, with neglect of the participatory finance, which is more suitable to the micro enterprises. It is also worth mentioning that out of 18 microfinance institutions, the Islamic microfinance institutions in Pakistan, only one, that is Ahuat, following the model of Qard Hassan, is leaving any significant impact. And it is carrying more than 90% of the clientele of Islamic microfinance institutions, as well as the gross finance portfolio, which in other words means that all the remaining institutions are not sustainable. They do not have the effective scale of outreach, so much so that some of the institutions, they have not even crossed the clientele of 200 to 500. So this reflects that the constraints to which these institutions are actually facing, so they should be removed to achieve the scale of outreach. Similarly, there is low efficiency of micro enterprises, and the reasons being that high cost of acquiring finance and farmers' access, or I would say that they have the last resort to the suppliers' credit, to the commission agents and the middlemen, which cost them 62 to 80%. Then concentration of product again in Murabha. There is no supply chain intervention. The uneconomic size of the business, and you can see the size of the finance, that is not more than average of $151 and as low as 500 rupees, that is $47. So this size of finance is 50% of the conventional loans in conventional microfinance sector. There is no sustainable market linkages, and there is also a mismatch of structure of the financial products with the business cash flows and business cycle of micro enterprises. So keeping these constraints in view, the literature has been reviewed, which have covered the following subjects: the Islamic microfinance operating systems, models, particularly low-cost endowments and zakat, innovation in participatory modes for microfinance, the value chain interventions and suppliers credit through istijrar, effectiveness of solidarity group infused with the Islamic social capital, the Islamic banks for microfinance operations. This is actually one major area of concern, that despite persuasion of the central bank and guidelines for financing microfinance, the Islamic banks are not coming up, with sheer disregard to the Maqasid-e-Sharia and their social responsibility. The microinsurance and micro-takaful. The conclusions which have been drawn out of the review of literature is that a leapfrog approach is required. It is not actually the situation where the poor people or the central bank and the government, they should wait for the Islamic banks to come up to fulfill their responsibility. So, use of potential of zakat as social safety nets and for economic empowerment of the poorest and the destitute. Then diversification into supply chain products is needed, and the product development to replace the current coercive practice of the supplier's credit that has to be removed, and an alternative product that has to be developed. The micro enterprise development through partnership finance, that is Musharka, so it has to be developed. The Islamic microfinance institutions are using conventional method of bookkeeping and treating all types of financing as credit businesses. So that is why the correction and the sample accounting system that has to be provided to them and developed. The downscaling of Islamic Bank to meet objective of distributive justice is required, and there should be strategic linkages between the Islamic banks and the microfinance institutions for reaching the scale of outreach, the technology transfer, Sharia advisory, and product development expertise. Solidarity approach in Islamic perspective is required, and necessity of financial literacy program that is also felt very much. On the basis of these reviews and the conclusions, so the recommendations would consist of suggesting the operating systems and the product development, or I would say that innovation, at least in case of Pakistan. So we have developed two operating systems, one relating to microfinance operations through alliances between Islamic banks and MFIs, which I have already termed as leapfrog approach. Then second one is the microfinance operations based on Islamic endowments, that is Waqf and Zakat. Three products have been developed. The first one is the supplier's credit through Istijrar agreement. Perhaps this would be the first product to be introduced. To my knowledge, I have not seen any example of use of Istijrar, although there is hedging of pricing by the use of Istijrar, but the product for poverty alleviation or for the use of the bank that has not been developed as yet. Then there is another product, the agriculture supply chain financing for small rice farmers in Pakistan. And third one is Musharka for technically trained clients. So another thing which I would need to mention, that all these products, they have been based on ground realities, the case examples and the constraints of the client and micro enterprise sector, they have been framed, and on the basis of those case examples, the products have been developed. Let us come to the operating system first. So this is actually the linkage of the Islamic banks with Islamic microfinance institutions. As we know that the Islamic banks do not have their network in the rural and remote areas. That is why they are not in a position to provide access of Islamic financial services to the masses living in rural and remote areas. At the same time, the regulatory constraints, some of the regulatory constraints do not allow them to directly deal with the micro enterprises. So that is why this linkage has been proposed. And the process would be as under. First of all, the microfinance institution would carry out poverty analysis by using an appropriate model of this of the poverty scorecard, through which the different poverty bands would be identified, like the non-enterprising destitute, vulnerables, and the enterprising poor. Since the MFIs, they have to offer the products according to the situation that which poverty band the poor are related. For example, for the destitute poor, it is not possible to directly offer them some financing product. So it needs that their basic needs should be fulfilled first, and then their fixed and working capital and entrepreneurship training they should be provided. And again, they are not in a position many times to return the capital which is provided by the microfinance institutions. That is why the zakat and waqf they have to be used. After successive cycles of their trainings and Qarz-e Hasan as well as the grants, they would be able to graduate for the products where they have to return along with the profit like Muraba, Salam, and ultimately the selected clients with proven history, they would be provided the participation finance. The Islamic Bank and the MFI have to, in first step, enter an MOU detailing the broader terms and conditions based on the demand for Islamic microfinance for the clients of that institutions. The IMFI would organize their clients into solidarity groups, infusing Islamic social capital consisting of the necessity of repayment, unity, economic independence, ta'awun, adl, and ihsan. The MFI has to submit a complete business plan with its capability of human resources, the financial management, as well as other requisites to the Islamic Bank. The mode which has been suggested here is a restricted mudarba, or I would say that restricted mudarba line would be provided to the microfinance institution, and the Islamic Bank has to be more generous, deciding profit distribution ratio more in favor of the microfinance institution, allowing it to build up its own resources and also outreach to the number of clients which have actually been provided in the business plan. So once the IMFI stabilizes and it accumulates its financial resources, it can also invest with the permission of Islamic Bank its own capital into mudarba, turning it to the broader based musharaka, so achieving more viability as well as the more outreach of the clients. Now, there is another missing link with the poor people, and that is that they do not have any access to the deposit services. Now, since the Islamic Bank would be providing the greater benefit and greater proportion of the profits to the microfinance institution, the microfinance institution would work for collecting or directing the deposits of the poor people to the Islamic Bank. This financial resource will be collected by Islamic banks without any marketing cost or advertisement costs. And the State Bank of Pakistan has already devised a procedure for such deposit, that is through Asan account, which opens with only $1, and this Osan account can be operated through telco linked system. So this way, the poor people, these would not be required to go to the bank to open their accounts. Alternatively, a sub branch of the Islamic Bank can also be opened in the vicinity where they have direct access to the Islamic Bank. So this is actually the indicative diagram which represents this linkage, and you can see the green arrows establishing Mudarba funds with MFI, and then this is disbursed to the clients through different products and services. The savings they have routed to the Islamic Bank directly through the blue line. The second operating system that relates to the microfinance operations based on Islamic endowments, Waqf and Zakat, case of Punjab province. So this is actually a particular case. Here we need to keep in mind that the Waqf Properties Ordinances 1979, which have been promulgated by all the provinces, do not accommodate cash Waqf. But there is enormous amount of the properties, the physical properties in the shape of the residential houses, the commercial markets, which are available for issuing sukuk. So that is why we are proposing here that the properties mainly located in 3 cities of Punjab, that is Lahore, Faisalabad and Multan, consisting of the commercial shops and markets and residential houses, they should be considered as the underlying asset for issue of the Ijara sukuk. Since the asset would be there, the sukuk would also be tradable. And then in Lahore particularly, the marketplaces have to be located. The old property has to be demolished and it has to be converted into the new Waqf property, which means that the horizontal setting of the properties has to be converted into the multi-storied vertical setting, carrying multiplied commercial value. Then again, this proposal is constrained with certain elements. For example, all those shopkeepers which have already occupied the Waqf property, they would not vacate this property unless they have an assurance that they will be accommodated into the new property. And secondly, the Awqaf department, which is custodian of the Waqf properties, may also create the obstacles not to issue the sukuk against the existing property. And thirdly, an assurance is needed that the cash flows of the new property would be utilized for the poverty alleviation purpose. So that is why it is suggested that the Provincial Assembly of the Punjab should pass a resolution primarily including all these elements, directing the Awqaf department to issue sukuk, ensuring that the current occupants would get lease in the new property, and thirdly, the cash flow of the new property and also the sukuk, they would be shared with the microfinance institution. So in this way, a revolving fund would be established with the microfinance institutions. The corpus would be the new property, and the Islamic Microfinance institution will only accumulate the cash flows in its revolving fund. Now, we have also suggested that how this revolving fund can be used. This is the structure of the Sukuk issuance, and you can see that the credit enhancement, the sovereignty, the tradability, rating of the Sukuk, they would all help to reduce the financial cost of issuing the Sukuk, as well as they will attract the greater number of investors. And there is likelihood that oversubscription that happens, as in case of motorway Sukuk issued in 2005. They were also the sovereign Sukuk. There is also a progression of the products as well as the clients, that the fixed return modes offered to the enterprising poor would graduate for entrepreneurship finance, for partnership finance at later stage. And for the destitute poor, rehabilitation and entrepreneurial finance for non-enterprising is in two stages. That first, social safety nets, meeting consumption needs through zakat fund and developing entrepreneurial capacity. And second, providing fixed and working capital out of zakat fund through repeated cycles and Karde Hasan until the graduation for participatory modes. So this is also the indicative diagram for the transformation of the destitute, that in first stage they are provided the social safety nets, rather it could be different cycles. Then their entrepreneurship is developed, then investment in fixed assets and working capital through certain cycle that is provided out of zakat, and working capital through qard that is also provided through the zakat pool, as has been resolved in the Islamic Social Finance report of IRTI, that the poor people or the eligible or mustahaqeen, they are made owners of that pool. Then in the next stage, the Waqf would provide working capital for the participatory mode, and this will go on until they are in a position to have the other modes of financing. So then there is another concern of the entrepreneurship building or entrepreneurship development, for which the TOT or training of trainers for the credit officer would be arranged, and the contents of the TOT would be assessing clients' basic entrepreneurial competencies, helping clients to identify business ideas, helping them giving orientation about business operations, simple financial management, and these participants would also carry out a practical exercise that how the business would be identified and its other aspect would be completed. The donors like Pakistan Poverty Alleviation Fund, USAID, ILO can be approached to finance the trainings, and experts like the NRSP, Institute of Rural Management, can be hired for imparting training. These trainers, they would subsequently provide this training to the prospective clients. So this has been suggested for the reason that no such entrepreneurial institute as in case of BMTs in Indonesia, is in Pakistan for such client. That is why the team of the credit officer, it has to be prepared for imparting this training to the poor clients. Then third one is the cash work-based microfinance. So as I have already mentioned that the current law does not accommodate the cash work. However, the Trust Act of 1982 has some provisions for establishing cash work by the institution. And one good example is the trust of Ehsan Trust of Mizan Bank in Pakistan. But unfortunately, the Trust Act does not provide any regulatory measure for the cash work as required by the Sharia. So that is why temporarily they can establish their cash work under the Trust Act 1982, but at a later stage, when the provincial governments they promulgate the law and provide the regulatory measures for the cash work, then they can convert this to their cash works. The other procedures that would remain as in case we have just seen in the revolving fund. Then we are coming to the products. The first product that has been developed, or I would say that it is the outline. Actually, the developing a certain product, its contracts and allied documents, that is actually an advanced task and it requires time. So that is why we have developed this outline for the supplier credit. So the case example and the constraints faced by the paddy growers or the rice growers in Pakistan is that they have to sell their produce to the artis. These are the middlemen and the commission agents. And in this case, they provide them the inputs on loan against their commodity. And once the commodity is sold to them, they delay the payments and charge higher cost to them as well as commission for selling their commodity. And we have already mentioned here that this cost from 60 to 82%, as the research studies they have concluded. The second option to the rice growers is that they sell their rice directly to the mill. So this would only be in case when they have not taken suppliers credit from the brokers or the commission agents. If they are fortunate enough that they can sell to the rice mill, again they are constrained with certain elements. Generally, the rice mills, they take credit limits from the banks. And again, generally, they have default on the previous credit limits. So that is why the credit limits of these mills are delayed. Against providing the commodity to the rice mills, the farmers are given the payment vouchers. But due to delays, they have to sell these vouchers against 20 to 30% discount, which is an additional cost. So keeping these two major bottlenecks into mind, so we have suggested the instrument based on istijrar agreement. As you can see that the istijrar facilitate purchasing supplies from time to time in required quantities. Each time there is no offer and acceptance required, that is bay'at-ati, and there is one master agreement where all terms and conditions are finalized. But at the same time we have to look for the fiqhi details in summary, that while the Shafi'i, Maliki and Hanbali schools, they do not agree to finance through istijrar because of the reason that the possession is taken before the decision of price, and the price is paid at a later stage, and even there is ignorance about fixation of the price. But Hanafi school of thought, out of urf and the sammo, that is the custom and the tolerance, as well as istihsan, that is jurisprudence, they allow istijrar to be used as a mode of sale. Now, since in Pakistan, the overwhelming belief relates to the Hanafi fiqh, so that is why this product has been taken as an alternative of this supplier's credit. Mainly, the guidelines have been taken from Fiqhi Muamalat, Volume 3 of Muhammad Taqi Usmani, published in 1998. Usmani suggests that istijrar can have two types. First type is that where the payment is made in advance. And this could only be the case of salam and istijrar. But in that case, the requisites of salam and istijrar, they have to be met. That is why this possibility is ruled out on one hand. And secondly, the farmers, the prospective clients actually need credit. They do not pay cash or the price in advance. And secondly, this can be treated as an amana. If it is amana, then the shopkeeper cannot use it. And thirdly, the qard, it can also be conditional. And again, this is ruled out. The second is the istijrar with deferred payment. And this is more feasible. This is more feasible. And it has again two alternatives. One is that the price is not known, and other is that the price is not known. So that is why we have opted for the istijrar with deferred payment, where the price is known at each time the sale is concluded. So this is our basic premise on which we have developed the product. The case example is that a small steel welding shop manufacturer in the town engaged in manufacturing of steel items purchased raw material from a supplier. The supplier extends supplies as and when required against 15 days credit. But the business cycle of steel welding shop concludes in 60 days. Due to mismatch of the credit facility provided by the supplier and liquidity available with the manufacturer, the latter is forced to borrow from the market against payment of interest, which lowers the business productivity as well as erodes the recycling capacity of the manufacturer. This is just a hypothetical example, but this is very common. This mismatch is very common, and they have to actually lose much of their business by paying interest and the excesses. What are the alternatives? Alternatives: conventional running finance facilities. This is not Islamic. The running musharaka, that is oriented to corporate sector, and it also invites Sharia objections because it has ultimately becomes a fixed rate financing instead of musharaka. Muraba, it is not practicable because of the documentation and other requisites. And if the client goes for master muraba and undertakes sub muraba at each transaction when he is taking supplies, so all these documentation and requisites and also the offer and acceptance, all these documents they do not allow. That is why it is not practicable. Salam, it is not practicable, as we have already discussed. Now, Islamic banks can offer istijrar through following process. The Islamic bank can enter istijrar agreement separately with supplier and the manufacturer, where offer and acceptance is not necessary, as we know, and the client is allowed to take possession of the goods from the supplier, being authorized agent of the bank or IMFI. The supplier provides to the bank the record of all sales and respective prices duly endorsed by the manufacturer on fortnightly basis. Because his credit period is 15 days, Islamic Bank can also participate in SBP credit guarantee scheme where 60% of the bank's genuine loss is compensated. Then Islamic banks puts on certain amount of markup on the price paid to the supplier, which becomes actually the istijrar price for the client. The client settles with known customary and the benefits which are derived out of this transaction. The manufacturer is saved from borrowing from the market money lender against heavy payment of interest. The returns to the business increase due to saving in cost of borrowing and having opportunity of recycling the business returns, because out of generosity, the Islamic Bank or IMFI may not charge any markup on the price which has been paid to the supplier. The client settles with the known customary and simple transaction. The Islamic Bank should be generous, as I have already discussed. So this is actually the indicative diagram, and you can see that the manufacturer is acting as the agent of the bank and taking supplies intermittently from the supplier. There are two istijar agreements, the blue arrows, two-headed arrows. There is one agency agreement between bank and the microfinance institution, and the other transaction flow. Finally, there is payment in lump sum or in installment by the manufacturer or the client. So alternatively, the banks can finance the microfinance institution. But in this case, the credit guarantee scheme allows 40% of the losses to be picked up, which means that if they directly finance, the 60% of the bona fide losses they have to be picked up by the central bank. But if they provide finance to the microfinance institution, that is wholesale financing, that in this case, the 40% losses they would be picked by the central bank. The agriculture supply chain financing, the ground reality that consists of again in two ways that we already discussed, that either he has to sell to the Arthi, which is the commission agent or the broker, or it has to sell to the rice mill directly, but he is loser in both cases, as we have already discussed. The proposed solution. There are two financing intervention in this case. One is financing the customer through Muraba for the purchase of inputs, and variable maturity Salam for providing liquidity. As I will show in the diagram. And the second one is the intervention, making arrangement between IMFI or the Islamic Bank and the rice mill by creating a mudarba. The MFI being Rabul Mal and the rice mill being Mudarib. Let us see that here you can see that the Mudarba fund has been created, and on the other side the rice farmer is financed through the Murabha and the Salam, which has been indicated by A, and you can see detail here that 8 months Salam is provided for preparation of land, payment of charges to the labor, tractorization, purchase of water, payment of diesel bill, payment of the electricity bill, then weeding, hoeing, etc. So since all these services they require the liquidity, that is why a longer term Salam contract against the delivery of paddy that is contracted with the farmer. And the longer term, again 8 months, Muraba contract for provision of the seed, fertilizer, and pesticide that is again contracted with the farmer. So little before the harvest is Salam contract of 1.5 months that is contracted to pay the expenses of harvesting, threshing, transportation, and marketing. So these three contracts, which are clubbed into the master agreement, they actually had inbuilt risk mitigation as well. So giving everything through Salam may have leakages into consumption and other purposes. Giving all Murabha for purchase of the inputs may not provide the liquidity to the farmers. So this is a total credit approach. In this approach, there is lesser chances of misutilization, and there is a price benefit to the farmer. A longer term Salam contract and a shorter term Salam contract. Even another Salam contract can be provided in between these two Salam contracts with more saving, with more cost saving with the farmers. Now let us coming back. There is a tripartite agreement among the Islamic Microfinance Institution, the rice mill, and the rice farmers who are client of the IMFI. In this case, the rice mill has to purchase the paddy at competitive price from the farmers with prompt payment. Since Mudarba has been created, and sharing of the profit is actually business case for the rice mill. And again, the rice mill can be given an advantage if certain threshold is crossed by the profit. Then the excess profit can be gifted to the rice mill. So this actually gives an automatic incentive. And you can see the lower part where is the market. So the trading is purchasing rice from the farmer and selling into the market. Ultimately, this Mudarba is liquidated in a period of 1 to 2 months. The third product, which is the Musharka for technically trained clients. This is a very specific segment. We experience in Pakistan, maybe you also experience in your countries. The poor families, they engage their children at the age of 8 to 10 years with different businesses. And all these children, they are known as Chota, means small boy. And you can understand that they are intern of the business. They spend about 8 to 10 years.
Okay.
Yes.
Sorry. If I can have a call at 2:30, and you don't want to finish with you, but I would like to go. Because I have a call with somebody outside the kingdom at 2:30. Can you please
I think it will be about 5 minutes.
Can you share the drive with us? Can you send to us?
Yes, of course.
You will send.
Of course. Okay. And if you see the businesses, these are the tea stalls, restaurants, automobile workshops, mobile phone repair shops, clothes stitching, electric repairing shops, and small manufacturing concerns like USP and Specialized. This is very particular, USP and Stabilizer. The Pakistan is actually is suffering from the shortage of electricity, and this is a very lucrative business. Then handloom weaving, carpet weaving, etc. These interns are paid on daily basis, just like $1 or less. Even research studies that show that it is not more than $6 per month against 12 to 16 hours of work. So these are all weaknesses of this system, but there is one very strong point, that spending 8 to 10 years as intern with these businesses, they learn everything. They learn how to establish business. They learn how to deal with the customers. They learn how to attract the businesses. Okay. And they have entire technical knowledge acquired in that period. That is, it is a strong case to detach them from their masters, provide them the opportunity to establish their own enterprise. So this is actually the case example and the background, that how we have developed this Musharka product. Now, preparation to launch the product is that the microfinance institution should carry out a survey identifying different businesses, particularly the promising businesses, and as well as the clientele which they would select. So we have taken one example of auto body shop. In this case, the most relevant considerations are the work experience required in repairing, body touch-ups, painting, etc., technical competence, maintaining a referral network of the customers, and adequate inventory for denting and painting. All this expertise knowledge is already with that intern. The outline of Musharka is that IMFI will create its separate pool of Musharka financing, but it has to be kept separate because of its nature of Musharaka. A business plan would be prepared comparable to the pre-feasibility studies already carried out by the Islamic Microfinance institutions. A formal business plan would help the Islamic Microfinance institution in monitoring the business. For example, if there is a larger deviation from the expected profits, then the microfinance institution has to be vigilant and go for intensive marketing. The maximum limit can be capped, for example, 75,000 rupees in first cycle of 6 months. Then it can increase by 25% in each subsequent cycles. So it is assessed that this enterprise should sustain in a period of 1.5 years, and the IMFI should discontinue its financing maximum after 3 years. The cash flows and net profit would be determined according to the business results, but will be matched with the ones estimated on the basis of the business plan. Now, profit sharing ratio will be predetermined, but the ratio of MFI should preferably be equal to the operating cost plus an appropriate growth margin if the funds from Waqf has been utilized. But if the funds have been acquired from the Islamic financial institution or some other source, then the financial cost would also be included. But in any case, the MFI should not charge more than the operating cost or operating plus the financial cost. Then a certain minimum amount of profit can be appropriated to the client every week or fortnight, treated as online payment, to sustain the client's consumption and business expenses subject to the settlement from subsequent profits, and this is allowed in case of participatory finance. IMFI would agree to give up his right of its share of the excess amount of profit in favor of the client. The Musharka capital contributed by the MFI would be redeemed periodically along with the payment of the profits. The client as managing partner shall be liable for loss caused by his misconduct, negligence, or breach of specific terms. Otherwise, each party has to be at the loss according to the ratio of contribution and investment. However, MFI may voluntarily absorb the loss of the client in genuine cases if its capacity allows to do this. The business would be properly monitored and the client will be given simple training of managing its finances, like keeping receipts, invoices, the incomes, expenses. And the client would also be helped to acquire the supplies and also to fetch the customers if needs be. Otherwise, as we have discussed, he has become master of all these expertise in 8 to 10 years. Okay, and this is all about this. I'm really thankful for your patience.
Thank you very much, Dr. Khaleequzzaman. You have made exactly in 1 hour your presentation, which is a kind of really risk management that you are used to have the skills that you have. I open the floor for question and answer. We have about 15 minutes, so if you have any question, please feel free to ask Dr. Khaleequzzaman.
Yes.
Thank you, Dr. Khaleequzzaman, for the presentation. My question is about istijrar, the contract, and how it is different from murabaha, which is seen as kind of unjust, especially in Islamic microfinance applications. So what are the main differences between the istijrar agreement or istijrar financing and murabaha financing, and is it also applied in any country? I don't know. I haven't heard about it yet. Thank you.
There are many differences between murabaha and istijrar. And there is also convenience and simplicity in istijrar as compared to murabaha. So first of all, there is only one master agreement which is signed between the bank and the client, or the supplier and the purchaser. There is no requirement of offer and acceptance, since it is a kind of bay'at-ati. Again, the number of documentation is replaced with 1 or 2 documents. The intermittent supplies, they can be finished more easily in case of istijrar as compared to murabaha, where every time you have to execute the documents, you have to execute the offer and acceptance, and also you have to intimate the bank through declaration that the goods have been possessed. Again, there is a declaration, right? There is an agency contract. Okay, so all these contracts and documents, they are avoided. They are replaced with the simplest 1 or 2 contracts or the documents. And secondly, this is not being operated anywhere as far as my knowledge is concerned. The Islamic Bank Bangladesh has given a product line including istijrar. They have also mentioned some loose arrangement through which the istijrar can be executed. But I have gone to their last 5-year financial statements. There is no indication of istijrar which they have. The istijrar has been proposed by many researchers for price hedging, but not for this type of credit. Yes, please.
Thank you very much for very interesting presentation. I'm particularly interested in this restricted umbrella of form of financing between 2 financial institutions. because in my work we provide financing to financial institutions, including microfinance institutions.
Okay. Yes.
So the question is how the risk associated with Mudaraba financing is mitigated in that structure.
Okay. As I have also indicated that there could be 2 or 3 types of risk: the equity investment risk, the fiduciary risk, right? So in this case, first of all, the Islamic Bank has to be vigilant, and there should be strict appraisal of the proposal put up by the microfinance institution for creating mudarba between these two institutions. Then the Islamic Bank can also provide investment risk reserve. And thirdly, in case of fiduciary risk, the Islamic Bank has to be vigilant on account of the Islamic Microfinance institution that whether the intermediation is being undertaken according to the Sharia requisites or not. But on top of it, as I have already mentioned, that if the Islamic banks, they are engaged with providing wholesale financing, as in this case that is mudarba, to the Islamic microfinance institutions, then they can also participate in the state bank's program of credit guarantee scheme, where 40% of the bona fide losses of the Islamic banks would be picked up by the State Bank of Pakistan in lieu of providing this financing to the microfinance institution.
Just wondering, can we apply this in general conditions? So like you're talking very specific to the case of Pakistan. Well, the question most probably is a general question that can be applied to anywhere else as well. So, how restricted mudaraba, if I'm trying to rephrase the question, so how restricted mudaraba can be applied where there is no guarantee from the central bank?
There is no problem in first instance to go for restricted mudarba, because it actually restricts the intermediation only for the purpose which have already been defined between the two institutions, right? But as I have said, that there are certain methodologies, practices, and the vigilance which is required, and the strict appraisal of the proposal of the microfinance institution, which can reduce the risk of the Islamic bank. And even if the credit guarantee scheme is not available, as in case of Pakistan, generally the investment risk reserve is built up out of the profits realized from the mudarba by the financing institution. So these are actually the very simple to understand that how the certain risk would be indicated. And again, if there is impairment to the equity of the bank and there is a loss, part loss of the capital as well as loss of the profit, then it becomes a credit risk. Then you have to actually manage in that way that how the credit risk would be, since there are no guarantees to be allowed in this case. So third party voluntary guarantee can also be asked, as provided in the case of musharaka by the OFI Sharia standard applicable to musharaka financing. But that has to be unrelated voluntary guarantee. So in that case, the MFI has to actually approach certain guarantor. And you can also see the example of the Islamic Development Bank. It stands guarantee for the poor countries while they issue the musharaka sukuk, mostly in case of African countries. So this is actually the live example. And this is also allowed in the Sharia standard applicable to musharaka financing.
Any other question?
Yes.
Thank you very much, Prof. Yeah, it's a good work you have done. You try to have more product, but given the challenges that you address it, you study the cost and outreach. Do you think there's any digital financing to solve this problem? Because the fintech now is a good solutions for good outreach and also for the reducing the cost. So using the product Mudaraba like traditionally has been done elsewhere, it needs to be enhanced by using, to be digitalized at least to overcome this cost.
Yes, you are very right. The technology can even enhance the financial inclusion. So there are 9 telco and the bank arrangements in Pakistan, but they are all microfinance bank and the conventional banks. There is no fintech arrangement or the telco arrangement in case of Islamic Bank or Islamic MFIs. Since there is no Islamic Microfinance Bank regulated by the State Bank of Pakistan, so that is why this telco has not been developed to carry on the Islamic financing. However, recently 3 fintech companies, they have been established in Pakistan, but they are in private sector. These companies, they have to look after financing privately, that is non-bank financing to their clients. They have to associate with the funders, maybe the crowdfunding, and then they have to disburse finance to the needy clients. But this is a non-bank and private sector. But you are right that using fintech, using telcos, so it can accelerate the financial inclusion. As I have already discussed, that the telco based Asan account would actually not require the client to go to the bank. So it will help him at his own residence, is in his own community and locality, to keep his deposit with the Islamic Bank.
If you don't have any question, we don't have any online question, so I think we finish this presentation now. Thank you very much, Dr. Khaleequzzaman. We really appreciate your time, your knowledge sharing with our colleagues and in our webinar. We hope to see you again, inshallah, soon in ILTI. So, Jazakumullah khair for your time. Thank you very much for the participants for coming and attending the session. Assalamu alaikum wa rahmatullahi wa barakatuh.
Thank you very much. I'm really thankful.